As a new day trader, you may have heard that it's very important for you to do both fundamental analysis and technical analysis. Well, you're in luck because in this video, we're going to talk about how to do fundamental analysis. We're going to talk about the differences between fundamental analysis and technical analysis. And I'm also going to give you some resources on how you can do your own technical analysis, including some examples. So stay tuned until the end to make sure you soak up all of this good information. If you don't know who I am, I'm Lakeisha Tomlin. I'm a former engineering manager turned full-time day trader, and I help day traders become profitable in 60 days and sometimes less. So you may be trying to figure out, well, what's the difference between technical analysis and fundamental analysis? Well, simply put, fundamental analysis involves reading news, but of course there are some things that you need to be looking for, which I'll go over in a few minutes. But basically, you're looking at news, you're studying the companies, you're looking at the fundamentals. Basically, at this point, you're not looking at any charts. Now, technical analysis, on the other hand, is about looking at charts, looking at the price action, looking to see where price was in the past, and not really predicting where it'll go in the future, but based on chart patterns and candlestick patterns, then you're trying to figure out where the price could potentially go. When it comes to fundamental analysis, there are 6 things that you need to take into consideration before putting your money into some company. And the first is growth in the sector. You want to look at other companies just like the company that you're considering, and you want to see that there is growth for the sector year over year. So one of the tools that I really like to use is called FinViz. And in this video here, I run you through the FinViz tool and show you how I look at each company and how I compare the stats from one company to another. It's a really, really helpful tool, and it's completely free. So go ahead and check out that video if you want to see exactly how I do that. So the first was growth, and the second was comparing your company to other companies. And the third thing you want to look at is how much revenue did that company bring in. You definitely want to make sure that that is going up year after year. And if their revenue is falling, then it may mean that your money may go right along with that. Another thing you want to know is the operations of the company. Now, you don't have to be an employee of the company to know fully what that company produces. Just go to their website, see what kind of equipment they may be manufacturing, if they manufacture goods. If they provide software, then what kind of software do they provide? Who are their customers? You want to just get a sense of the type of products that they produce and get a sense of what the sales may possibly be over the next year or even 5 years. So that's why it's really important to compare your company to other companies in the sector like we talked about before. It's really important to understand what their operations are, no matter if they're producing hardware or software. And then 5, just based on your own general understanding after looking at all of these different things, do you see this industry growing in the future or shrinking in the future? And if you see it shrinking in the future, what are some of the things that are popping up on the scene that you could possibly shift your attention to? So it's really good to do this research because you can get a sense of how the market could be changing in the future. So one good example is I'm reading this book by, actually it's not by Warren Buffett, but it's about Warren Buffett and basically his life and how he became first a millionaire and then a billionaire. So one of the things that he liked to do was basically look at the companies and in the same way that I'm laying out for you. And he was really interested in finding companies that were undervalued, but also had potential growth in the future. And this is basically the same kind of framework that he was using even back in the 1940s, even up until today, when he looks at a company to put his money in. And from reading this book, it seemed like market growth or contraction was one of the biggest things that he looked at, as well as how well the company was using their money. So anyway, these are just really simple things that you can do in order to figure out if a company or stock is worth your time. And the sixth thing is, what is the news around the company? So in terms of what is the general market sentiment about this company? Do people generally think that this company is going down, or do they think that this company is going up? Now I saved this for last because I really want you to take this information with a grain of salt, because sometimes depending on the company, there may be analysts who may have some sort of financial motive in order to pump up a stock or pump it down. So it's just really important for you to just understand what things are being printed about these companies, but not take it too hard when it comes to making your own decision about putting your own money into a particular company. So if you're enjoying this content so far, go ahead and give this video a like, and then also hit the subscribe button so that way you don't miss any other content like this. Now next, we're going to be looking at technical analysis, and I have so many other videos on this channel that goes over technical analysis in depth, and this video is just basically here to provide you an overview of what technical analysis is. So essentially with technical analysis, you're looking at charts, you're looking at dollars and cents, and essentially what you're looking for is an upward trend. So I like to use this in terms of spreading out to about 5 years or so, and maybe even longer. So for some companies like Apple, they have data going all the way back to the 1980s. And then there are some companies who have data that goes even further than that. So before I put any money in, I like to build a watch list of the companies that I'm interested in. And I did this way before I knew anything about technical analysis. I just wanted to keep track of the companies I was interested in. So I built a watch list, and then periodically, or just kind of randomly, I would go through this list and see what these companies were doing. Was the price up today? Was the price down today? What has the trend been over the past week, the past month, the past 3 months? So just looking at the price in those terms and just seeing what the general trend is. By doing this, you're getting a really good sense of the highs and the lows of the stock. And of course, everybody hears this buy low, sell high adage. They're not saying it for no reason. It truly is the way for you to get the best value from the stock that you're looking at, especially if it checks all the other boxes on the fundamental analysis part and it's showing an uptrend in the technical analysis part. When it comes to trading stocks, there always has to be a buyer, there always has to be a seller. So if there's a lot of selling that is happening, you will see the price of the stock go down. And if there's a lot of buying, you will see the price go up. This is just a natural phenomenon of the stock market in general. So just because you see a temporary dip doesn't mean that it's time to leave the stock. So that is known as a pullback, and pullbacks are completely normal. So say for instance, if you put money into a stock and it shot up, say you started at $50 per share and then it shot up to $150 per share. Some people, they would want to take out some of those profits and maybe put that money into other companies or just buy something really nice. People have all kinds of goals when it comes to investing or trading. So say for instance, if you were one of these people and the price jumped up $100 per share, so from 150 to 150, and you will see people selling. And all that is just a temporary pullback because people are selling the stock. It doesn't mean that the stock is going down. It just means that people are taking their profits or maybe moving that money around in some kind of way. And it only lasts for a relatively short amount of time. Now that time is completely unknown because we don't know anything in terms of when a downtrend will end, but basically that's generally what's happening. So if you look at a company like Apple, they have been in a really strong uptrend for many, many years. And you will see these little dips and then it'll go up. And basically that's all that's happening. It's just a quick pullback and then it shoots back up. Or at least that's what it has been doing in recent years. And then another trend you may see is sideways movement. So basically it's the price bouncing between two different ranges. So it'll have a high and it'll have a low. And if you look on a chart, it'll be very obvious what this high and low is. And that is known as sideways movement. Another thing that I like to look at when it comes to technical analysis is looking at the volume. So volume is very important because it shows you how many transactions are happening. Like I said before, for any time there's a buyer, there must be a seller. Anytime there's a seller, there must be a buyer. So there is a lot of transactions that are happening. And if you see a whole lot of selling that is happening, basically you'll see a lot of volume and it'll look red on a chart. And when it comes to a lot of buying pressure, you'll see really tall volume bars, but then it'll also be green to let you know that there's a lot of buying pressure that is happening, which can be a really good sign. So if you look at a company like Apple, you will notice that in recent times, they had a low of about 129, and that was the low point. And then shortly afterwards, you saw all of this upward momentum, meaning that people were buying the stock because they thought that it was a bargain. So volume is really interesting to me because it's something that I like to look at. And when I'm trading, especially as a day trader, I only like to trade really when there's a lot of volume in the market, because that means that the price could potentially hit my target price much quicker, and then I can take my profits and run for the day. For long-term investing, it's really interesting to look at, but it's not the number one thing that I look at when it comes to long-term investing. I mostly still look at the fundamentals, and then I look at the trends of the market when it comes to long-term investing. So when it comes to long-term investing, volume comes into play when I want to either buy something quickly or sell something quickly, and that is known as liquidity. So you only want to be putting your money into companies that have a lot of liquidity, and that's basically something that can be determined by looking at the number of shares outstanding. So for me in long-term investing, volume is important when it comes to liquidity. That means how quickly you can buy or sell a stock. Mostly people are interested in liquidity when they're interested in selling a stock and they want to get rid of it really fast. So typically I look at companies that are large cap or mega cap, or maybe even medium cap companies. And you can find this information easily on Yahoo Finance for a company that you may be interested in. So if you like this video, go ahead and give this video a like. And then if you haven't already, go ahead and hit that subscribe button, and I'll see you next time.